let me say this upfront. If there's one video you need to watch to understand how term insurance works, this is it. Because today, we're not just explaining theory, we're opening up an actual insurance policy and going through it line by line. All these confusing words like sum assured, grace period, return of premium, section 45, we're going to decode all of it like a conversation between two real people. So that by the end of this episode, whether you've already bought a plan or you're about to, you'll understand exactly what it says, what it means, and what to look out for. And hey, if you've got a policy document sitting in your inbox right now that you've been avoiding, or you're just unsure about the fine print, book a free call with Ditto. We'll go through your plan with you in just plain English. All right, let's begin. So the first thing you'll see right at the top, sum assured. That's the amount your nominee will get if something happens to you during the policy term. Think of it as your family's financial backup plan, the safety net that ensures life can still go on if you're not around to support them. Now, you'll see something like this below it. Payout option, lump sum / monthly income / combo. Now, let me explain that. Some policies let your nominee choose how they want the money, either as one-time payout, that's lump sum, or as monthly payments, like a salary replacement, or a mix, say 50% now and the rest over the next 10 years. At Ditto, we usually recommend the lump sum option. It gives your family full control. They can invest it, clear loans, or just take time to figure things out. No delays, no monthly dependency on the insurer. All right. Next section. You'll see two terms thrown around a lot. Policy term and premium payment term. They sound similar, but they're not. Policy term, that's how long you're covered for. Could be 30 years, 40 years, or till age 99. Premium payment term, that's how long you're paying for. You could pay for the full duration, that's called regular pay, or just for a few years, that's called limited pay. There's also single pay option where you pay once and you're done. So for example, let's say your policy term is 30 years, but you choose a limited pay of 10 years. You pay premiums for the first 10 and then enjoy 20 years of coverage without paying another rupee. Sounds tempting, right? It can be, but the premiums for limited pay are a little higher, so weigh that decision carefully. Now, moving on to the death benefit section. This is the core feature. If you die during the policy term, this is what gets paid. It's generally tax-free under section 1010D, and it doesn't depend on market ups or downs. It's guaranteed. But what if you don't die during the term? That brings us to the maturity benefit part. In a pure term plan, there's no maturity benefit. You survive, you get nothing. The policy ends. But if you've opted for a return of premium plan, that is ROP, the insurer returns all the premiums you've paid minus taxes when the policy ends. Now, let me be honest. At Ditto, we usually don't recommend ROP plans. They cost way more, sometimes 70 to 100% more, and the return isn't that great. So if you're keen on getting something back, you're often better off investing the extra amount separately. Okay, next up, the riders. These are optional add-ons. You pay a little extra for more coverage. Two common ones are critical illness rider. This pays you a lump sum if you're diagnosed with serious illness like cancer or heart disease. It's helpful for treatment costs or income replacement. Waiver of premium rider. If you get critically ill or permanently disabled, you stop paying premiums, but your policy still stays active. It's one of the most cost-effective riders out there, and we usually recommend adding it. We'll cover riders in more detail in another episode, but for now, just know they exist and they're worth considering. All right, here comes the fun part, the fine print, the part where people start zoning out. But let's fix that. You'll often see terms like nominee. That's the person who gets the money. Simple. Then comes the free look period. You have 30 days to review the policy. If you don't like the terms, you can return it with a small deduction for stamp duty or medical test charges. Grace period. Missed your premium deadline. You usually have 30 more days to pay and keep your policy active. If you go past that, your policy lapses. But you can still revive it. This is called reinstatement. Within 5 years, you can pay the dues, possibly take a fresh medical test, and restart your policy. But one thing to remember is once a policy lapses, your family is not covered until you revive it. So don't ignore those reminders. And if in doubt, book a quick call with Ditto. We'll walk you through the revival process. Then there are exclusions. This is what your policy won't cover. Things like suicide in first year, death while committing a crime, or risky adventure sports unless disclosed and approved. Underwriting is what happens before your policy is issued. Basically, the insurer checks your health, income, and lifestyle to price the policy. And if you've got a pre-existing condition or risky job, you might see something called premium loading, which means your premium is slightly higher because of increased risk. Now, one line that confuses everyone. Policy shall not be called into question after 3 years. This comes from Section 45 of the Insurance Act. What it means is once your policy completes 3 years, the insurer can't reject your claim just because you forgot to mention something minor unless it was outright fraud. It's a powerful clause, and it's why being honest at the time of purchase is so important. Once you cross the 3-year mark, your family's claim is almost guaranteed, provided there's no deliberate misinterpretation. Alright, a last few terms, please bear with me. Assignment. If you've taken a loan and pledged your policy as collateral, this gives the lender the first right to claim the payout. It overrides the nominee. Nomination. That's still your chosen beneficiary, but in case of assignment, the lender gets the priority. You'll also see surrender, which is basically cancelling the policy mid-term. Now, in pure term insurance, you don't get anything back, so surrendering only makes sense if the plan no longer aligns with your needs. And finally, the policy anniversary. It's the date your policy was first issued. This is useful for tracking when renewals or changes take effect. I know that was a lot, but if you've stayed with me till here, you now understand more about term insurance than 99% of people who've actually bought it. And that's the goal of the series, to make you truly confident in what you're buying. Are you still unsure about your own policy? Got doubts about terms, riders, or coverage? Just book a free call with Ditto. We'll go through your policy line by line, just like we did today. In the next episode, we'll look at some of the most common mistakes people make while buying term plans, like taking too little cover or falling for misleading features. I'm Shashank, and you're watching Ditto Insurance. If you like the video, drop a like and subscribe if you haven't already. I will see you in the next one. Until then, happy insurance hunting.